All right, everyone, welcome back. We're going to be going over highs and lows and why we use the highs and the lows as liquidity areas and why there is liquidity there. So let's map out some structure. All right. So above this high, there's going to be stop losses from the people that are moving their stop loss. So they're trading their stop loss from here to here, then to here, then to here, then to here, for example, let's say. All right. We're also going to have buy stops sitting up here. So buy stops pretty much it's an order that is just there. And the trader is waiting for price to come up, break the high. And because it broke the high, they think the price is just going to keep on going up higher. But in reality, what happens is it'll tag them in, then reverse to hit their stop loss. So it took out the stop loss from the traders up here and from the ones that had the buy stops, which are the ones that were down here. So both sides were covered, right? It's a big liquidity pool. It's a lot of liquidity above this high. And the same thing for this low, right? Vice versa. There are sell stops just resting below this low or exactly on that low right there. And of course, there's stop losses from people that went long here, right? Now, not to mention all these pullbacks, right? It's going to be stop losses all right here, right? So it's just giving price a reason to go lower. And price needs a reason. It needs fuel. It needs that liquidity to make that move, right? And that's why every high and every low in the market gets taken at some point. And because the market is fractal, it happens on the seconds, on the 1 minute, on the 4 hour, on the daily, on the weekly. It doesn't matter what time frame. There's liquidity above and below every structure point. Okay. That's it for now. On to the next one.